has been a growing focus on sustainability, and we at Value Research receive a lot of queries related to the ESG theme. So, in this two-part series devoted to ESG investing, we'll talk about its evolution, the importance of considering the ESG factors while investing, and evaluate this theme in the Indian context. Coming to you first, Dhirendra, can you provide a brief insight into what exactly is ESG investing and give a perspective on how it has evolved in the global context?
Uh, yeah, world over, there's greater awareness that in our uh, in our zeal to do business, in our zeal to do grow our economies, we really don't worry about the environment. We don't worry about the sustainability of our environment. So it all, the in the business context, it all started in 2005 when Kofi Annan, the United Nations General Secretary, called businesses and countries to sign an how to came called for a debate and basically making a lot of countries agree on a term that how to conduct business responsibly. And this is how the formalization of this design, the formalization of this concept came into being. Since then, over 3,000 businesses, investment managers have signed on the principles on which they will follow. And this is something primarily, worrying about environment, being socially conscious, and ensuring that you're governing in a manner which is not violative of these principles. That is it. And many businesses, asset managers, everybody has agreed to this, and it is catching up. World over, there are far bigger followers. In India, I think it's a relatively new concept being talked about, and let's see how it evolves.
All right, now, Chirag, we understand that some aspects of ESG were already integrated into the investment philosophy at Quantum since the very beginning. So, can you describe how the ESG investment framework has evolved at Quantum EMC?
Sure. If you look at our history, Quantum adopted what we call an integrity screen in 1996. It was integrity checks that we did on the company in terms of how they kind of treated the minority shareholders, what are the kind of business principles that they had, what is the overall business ethics of that company. And if it didn't pass our integrity checks, no matter how large that stock is in the benchmark weights, we would not even touch those kind of companies. So we have avoided much dubious management in India over the years, following this principle or relying on our integrity filter. And if you look at Indian landscape, there are many examples of poor corporate governance responsible for financial collapse of big companies. And these have been ranging across sectors, be it companies in the banking, software, FMCG, airlines. So you name it, there have been poor corporate governance practices that led to demise of many companies within various sectors. So the G of ESG was always at the core of Quantum's investment philosophy. And our framework was much like if you shake someone's hand, you count how many fingers you got back. And if you don't see 5 fingers back, then you never shake hands with that person again. So, in a nutshell, we think that corporate governance is a foundation that supports responsible business practices, be it financial reporting, be it environmental stewardship, social license to operate, or be it community relations or employee well-being that the company has to ensure so that the company is run much more effectively. So that was the governance aspect, which is always there. Coming to ENS, right? We had certain social aspects also built in into our framework in terms of how responsible or how questionable business practices were for that company. And in 2015, we got sensitized in terms of the increasing importance of ENS factors. To give an example, if you look at the global risk report from the World Economic Forum, if you look at 10 years back, there was just one risk from ENS side into the top 10 list that had larger impact in terms of the probability of it happening and the impact it would have on the global economies. Today, if you fast forward and look at that same report, 9 of the top 10 risks are emanating from environment and social aspects. So ENS is certainly becoming very important. It is having a much larger bearing on the way global economies will perform or how the companies will perform and respond to those challenges. So overall, E, S, and G all are becoming very important, and we kind of evolved our own framework. It's a proprietary framework that we kind of rely on to evaluate companies on ESG. So we kind of started instilling our own team in 2015 and went through our learning curve to evolve a much robust process of measuring companies on E, S, and G. So it is completely in-house. We rely on our own team, and that I think gives us an edge in terms of how we measure companies on ESG. And if you reckon, the market is also shifting in terms of rewarding companies which are very good at these aspects in terms of how they understand, how they measure, how they manage these kind of risk, and they are rewarding such companies with higher valuation. And therefore, we think that the framework that we have built on ESG will help us in terms of evaluate that company and get that reward that the market is willing to give.
All right, then, Dhirendra, what is the case for ESG? Considering ESG factors while investing.
No, the basic premise is pretty straightforward. Uh, what is good for the world, what is good for the society, and a good conduct. So I think the G part of it is rooted in Gita, that you do right and things will play out well, and you will not be you won't have regret after many years of doing business, conducting business. So that is plain and simple. And I think there is a much bigger thing to conceptually understand it. I don't look at it as a mere thematic fund which is configured and complying with this. Uh, Environmental friendly, I think, if we want a sustainable world, we should worry about it. A business which is not socially conscious, I think, it will have, we know that, and it's profitable too. Uh, we can say with our own experience that Tata Group, which is socially a very aware, conscious, and, socially friendly, with their deeds and their conduct, it's something where people swear by, and that translates into a very different kind of shareholder loyalty. That also translates into a lower cost of borrowing for the Tata Group. If you have anybody or any sundry company, a good credible company with strong balance sheet coming to the market, and if there is a Tata Group with relatively not as strong balance sheet, I bet that Tatas will be able to borrow that money relatively cheaper. Uh, that name matters. And I think that in that build up of that name, there is a huge contribution of being socially conscious, environmentally. Environmentally we have to see, because there are businesses which cannot really change pole vault into being environmentally friendly. Business has its own cycle, but I think the S and G part of it, businesses have a choice to make. And there, I think, what is good for the business, what is good for the society, what is good for the environment is also a profitable deal. That is something which requires, being hammered into. And I think investment managers have far bigger role to play. They have a far bigger role to play, and it reflects in their choice. Right now, we see the whole, shift primarily driven by the foreign investors, because there a lot of money is getting channelized. So foreign institutional investors putting their money, and they showing their preference for ESG, or ESG, that they have that mandate that money must go in such companies. Increasingly, if we have Indian companies also, and lot more money coming that way, or even it may not necessarily be the thematic money coming to the ESG fund, but even the normal diversified equity fund and fund managers can drive that thinking. That is one thing. There's another thing I would like to share, that there is some talk in the regulatory framework at SEBI, that should they allow something like ESG in the debt fund as a thematic fund. That will be a very interesting thing that will actually drive, because we haven't seen too much. This was being talked about, this was debated internally, and I think there are some issues in terms of which definition to follow, and how to, because the moment the regulations come into being, it there must be, because in our country the rules are quite prescriptive. They are not principle based. So in that sense, it's a very difficult thing to do, but that is also being thought about.
Chirag, can you please share your views about why you think one needs to consider ESG as part of one's portfolio?
Yeah, if you look at ESG factors, more or less they are kind of non-financial factors, but tend to have a material impact on a firm's valuation. So we think that there is enough evidence and research that suggests that it does have an impact on companies' cash flows, be it in the top line, be it in the cost that the companies is kind of trying to reduce, be it in terms of any regulatory or legal intervention that it will face, be it in terms of the capital expenditure that they kind of incur. So overall, all these factors tend to have an impact on what the company thinks, the way it kind of operates its business, and it will have an impact on the cash flows. So we have seen ample evidence that suggests, like Dhirendra was talking about the Tata Group, which is very, very evident of the fact that these companies which are operated in a way that don't harm the environment, don't have a positive contribution to the society, tend to have a lower cost of capital. They tend to have a better operational performance, and therefore the street kind of rewards them with a higher multiple when it comes to their businesses. So overall, there is enough evidence also at the company level. Companies that have done well have kind of done better in terms of, who have good ESG traits have done better in terms of financial performance, and therefore better stock market performance. Also, there is evidence that ESG indices overall, which is an aggregate of those kind of stocks, have also done well. And if you look at ESG funds, they have further done well. So there is evidence piling up, and that is why we are seeing increasing adoption of ESG. So ESG, though be non-financial factors, it's kind of looking at various traits of the businesses and therefore unearthing various risks that the business can have and the opportunities in which they can capitalize on to drive the business performance. So it is they're very, very evident, and with the piling of evidence, and ESG at the end of the day is still evolving. And as it evolves, more evidence gathers, there will be more adoption of ESG. And I think there is sustainability as a driver of long-term returns. I think there is merit in that. If you have seen various forms of long-term investing, which have been followed by various investment gurus, they kind of tell that longevity is only possible when you have a positive societal impact, and therefore the compounding of returns that you're looking about will only be achieved then. So I think ESG is a great way to get into that long-term investing. And I think that is why investors should kind of adopt and look forward into investing in ESG.
Okay, and which ESG factors matter and how much do they matter? Can you please give an example explaining the concept of inclusions and exclusions while evaluating ESG parameters at Quantum?
So we take a positive approach when we evaluate companies on ESG. We don't kind of neglect companies because they have a very high carbon footprint. I give you an example of cement companies in India. Cement globally contributes to about 6% of overall pollution in the world, right? Cement alone. And if you look at cement companies in India, because the way they have evolved, the kind of the technology they have adopted, they are far better in terms of the environmental footprint, even when compared to the European giants like Holcim and Lafarge. So I mean, looking at cement companies, they are kind of better in terms of their pollution levels. They are kind of better in their water usage. They're kind of better on their waste management. So across all parameters, they are much better. Despite they contributing a high thing, they are doing their bit. They are going beyond their traditional remit and trying to ensure that their environmental footprint is kind of getting better day by day. And they're kind of consciously working towards it. And that is why you find Indian companies much better than the European companies as well. So we take a positive approach, not neglect any companies just because they have a particular trade. We see the intent and we monitor the progress in which the companies are moving towards. And therefore, we kind of invest in those companies. So overall, within the framework, the governance aspect is much bigger portion of the ESG factors, because we think if you don't have good governance, it will be very, very challenging to deliver on the E and S side. Even if today you are better, there could be lapses in the future if you are not a good governed company. So we lay a lot of emphasis on governance, but we lay a lot of emphasis on materiality of the company in the sector in which it operates. So for certain companies, E will be more material as compared to S. It doesn't mean that we don't look at S factors at all, but we give a lot more emphasis on the E factors where it is related to. So that is how we kind of look at each company on a positive basis and try to measure their ESG traits. And that is how we think we kind of have an edge in terms of uh, laying emphasis on G, because it is very difficult to go wrong on that. When the company is very well governed, they have good board, good management, they'll ensure that the company has other aspects in place as well.
Okay, and Chirag, before we move on to the viewers' questions, one last question to you. Can you explain the broader ESG investment framework in place that governs the Quantum India ESG Equity Fund, and if and how it has influenced the overall investment philosophy at the AMC?
Sure. So there are two things that we kind of differentiate what we do in terms of evaluating companies. One is depth of research. So there is, if you look at the Indian landscape today, it's still evolving. Company disclosures, it's a mixed bag. There are certain companies which have been giving out fabulous data on sustainability for years together, and they have great practices. Whereas some companies are just waking up to the fact that they kind of have to measure these and kind of give out more data. So public disclosures are there. At the same time, we reckon the fact that there is a lot of incentives for companies to give out glorious reports and greenwash their way out. So what we do is we just don't rely on company disclosures. We kind of go beyond. We try to verify that with kind of interacting with various stakeholders, like, for example, pollution control boards, be it with other stakeholders, be it customers, suppliers, vendors, employees. Try to do a 360-degree check to verify the information that the company is giving out, to ensure that it is accurate and we just don't fall into the pitfall of greenwashing. So that is one area. And for a company across ESG factors, we kind of measure more than 200 parameters on various different things within E, S, and G to kind of say that come out to a holistic score. We lay a very small score to the disclosures that the company is giving, how transparent the company is, and more on the subjective evaluation of those factors. So a company will be scored on all three parameters, and we come at a holistic score. And any company that has a positive ESG score is eligible to be part of the universe. Within the ESG framework, we also ensure that we also look at the financial sustainability of companies. When we measure sustainability, apart from ESG, the financial sustainability is also important. So we don't look at the quarterly numbers or the yearly profit and loss numbers. We see that if the company is financially sustainable or not. How is its balance sheet? Is it kind of highly levered or not? What are the kind of capital allocation decisions the company has made and whether they have been right or not? So we look at financial sustainability from that lens. And one is depth of research, and second that we kind of do it is we look at how we want to make it a true to label kind of fund, right? So when we invest, we lay a lot of emphasis on the ESG, and we let sustainability be the driver of the returns that the company generates. So our scoring or our weighing is based on the scores that we have on those companies, the ESG scores. So that is how I think that both the things in terms of depth of research and being true to label gives us an edge in terms of the way we can look at ESG as a broader investing. And overall philosophy at Quantum, I think it has influence. There is a lot of, we do have two separate teams. One is the equity team and one is the ESG team. A lot of cross team feedbacks, interaction that happens, and that kind of builds onto our the experience that we have in investing in over the last 2 decades, builds onto our experience in terms of how the company is in terms of governance, etc., and it influences our ESG framework. Even on the other side, we did have G as a good emphasis into our investing at all times. And we also had social factors. Now we are better at evaluating companies in terms of their practices with the ESG framework. So overall, it has influenced our view in terms of where we look at companies. And the feedback is on for both the sides, be it for a traditional value product or be it for the ESG product.
All right, time now to move on to our viewers' questions. The first one comes in from NM Rajagopal Sridhar, and he asks, should ESG funds form a part of the equity portfolio? And how different are they from a good flexi cap or a large and mid cap fund? Dhirendra, can you please answer that one?
No, these are early days for the ESG fund, and I don't think investors have enough choice to make a credible choice. But I think it is evolving. But I think in Indian context, the more important thing that will happen is ESG component of the mainstream fund. And that will actually, if some disclosure is being made available, I think that will become a very crucial determinant. And also, what Chirag was actually emphasizing, that what is good for society, what is good for environment, is also good for business. And that thing has definitely, and corporate governance, I think, even before the ESG talk became mainstream, uh, corporate governance in India has been a very significant, has been one of the crucial differentiators of a long-term winner, or and an also ran or a flash in the pan or whatever, a company which actually becomes a blockbuster only to disappear. So durable businesses, they should have this component. So from that standpoint, it is important, but I think in a measurable way. How do we quantify it? How it gets defined? I think those things are still becoming, far from becoming mainstream in India. And disclosure in the portfolio itself, in terms of what part of the portfolio is definitely not compliant, or not will not fit in with the definition of this, that itself will actually start contributing if we are able to establish some correlation. But I think right now investors don't have enough choice.
Over to you, Chirag. Manisha Joshi wants to know if it's worth investing in ESG funds, both for the short and long term, and how much return expectation should she have from them?
Yes, so I think ESG investing is meant for only long term. Short term shouldn't even try moving into ESG investing. There is a reason for that. True benefits of ESG investing can only be reaped over a long term. When you have a business cycle that takes place, in a down cycle, the weaker hands will go out. They'll find it difficult to sustain and they will die. And the stronger businesses will even emerge stronger because they are sustainable businesses. They are kind of financially stable, and therefore they will continue to remain and exist. And when there is an upturn, they will be able to capitalize on the opportunities, gain market share, gain higher revenue and profitability, and that is how they will thrive. So one is surviving in the downturn and thriving in the upturn is what the sustainable businesses are good at doing. And therefore, when you wait over a cycle, that is when you kind of make money into investing into ESG way. So you have to look at a long term, at least a business cycle, which usually takes at least 5, 7, 8 years kind of time frame. So if that is your horizon, you should invest in ESG funds, and you will reap the benefits of the long term benefit that will come because of the existing, or they move over a cycle.
The next question is also for you, Chirag. Sambaran Mitra asks, how is Quantum's ESG equity fund different from its long-term equity fund? And can you give an example of a company that can belong to QLTEF but not to ESG? And conversely, one that belongs to ESG and not to QLTEF?
Sure. As there are two common things between the strategies. One is the emphasis on liquidity. We do buy stocks that trade at least $1 million a day over the last 12 months. So we do have both the products have kind of emphasis on liquidity. And second is emphasis on strong governance, because ESG governance being part of ESG, and also the value fund has an emphasis on governance. So that is two common things within both the strategies. But if you look at the what is the driving factor, in the value strategy, it is predominantly valuations that drive the returns, or that it is the banking that the fund has. Whereas in ESG, it is ESG scores of the company, and second is the financial stability of the company. Those are the two driving factors behind how we select stocks in ESG. So if you look at the overlap between the portfolios, it's usually around the third of the portfolio which kind of overlaps, not more than, we have seen it diverge in a range of 30 to 40%. And that's been a usual overlap that we have seen on both the strategies, despite having those two commonalities. So that's not too high overlap between the two strategies. Uh, Now, if you look at, given that the value fund banks on valuation and this fund banks on ESG, there are certain stocks, for example, something in the coal sector like Coal India, which will have a significant high environmental footprint, and maybe the labor practices within that will also determine how the company will perform. So overall, it will be difficult to get that kind of stock into an ESG fund. Uh, and on the other side, if you were to look at the value fund, which doesn't have exposure today to FMCG stocks, for example, given FMCG stocks are highly valued and value fund likes to buy stocks which are usually at 35-40% discount to their intrinsic value, at these times they will not fit into their value framework. Whereas given these companies have good ESG traits, they are very good in terms of all the parameters on ESG, have great board, great management. Therefore, they fit in well within the ESG framework. So ESG framework has been value agnostic. We will kind of buy into those FMCG stocks today. So be it the Nestle's or Levers or be it the homegrown Maricos of the world, the ESG fund will invest in those funds, and we have seen that they have delivered over the long run. Given that they have good ESG trades, they are valued high by the street. So these are the good examples in terms of what will come into the long-term equity value fund and what will come in the ESG fund. The example that I gave of Coal India is just a theoretical example. Long-term equity value fund doesn't own Coal India, but it was if it is available at a significant discount to its fair value, and if there were catalysts that the fund manager sees, then they could potentially buy into that stock. But that will unlikely be the case for QESG, given the where the company stands today.
Now, Virendra, Kiran believes that the pandemic has revealed that markets need to pay attention to ecology as well. So, is the Indian market ready for ESG funds or ethical investment options? And if so, where do we see them going in the near future?
No, the pandemic definitely, brought in forefront. People are worried about it. People are concerned, and it brought about a very different degree of awareness. But I think, generally speaking, past couple of years, there is far greater awareness about being environmental, conscious about the social or the environmental impact of many businesses. But I think far bigger impact will be uh, greater institutionalization of the market, because these are principles which can be followed by the institutions, and if they are able to mobilize the money, individual investors don't have the wherewithal uh, to really evaluate companies based on ESG scores, or differentiate between them, even differentiate between different kind of ESG scores available. Uh, so I would say that greater institutionalization, mobilizing more amount of, if more money gets channelized into ESG fund with a mandate that it will not be invested. So, it becomes a chicken and egg story. Unless if greater institutionalization, market and money getting mobilized in such funds, which will find its way into such companies, which will create. So then it becomes a vicious cycle, a virtuous cycle, and then not vicious, virtuous cycle, and then right now we are at a stage where people are chasing performance, and I think long-term orientation and mobilization of money in such funds itself will drive an appetite for this.
All right, today's last question has been sent in by Padma Wagle. And Chirag, Padma asks, shouldn't ESG funds be a part of a broader risk assessment framework at the AMC level than just being restricted to ESG-themed funds?
Yeah, sure. I think over a period of time, I think ESG integration will increase. ESG, if you need to understand, it's evolving today, and as it evolves further and as evidence piles up, I think more and more adoption of ESG practices will happen into the mainstream funds. So if we do expect that there will be mainstreaming in terms of integrating ESG practices within the overall investment frameworks. But until it evolves, until there is more confidence, until there is more evidence, I think it will take its own time in terms of integration. So there are funds who kind of have a long emphasis on governance. Like for the long-term equity fund, we do have a strong emphasis on governance, and it's not today; it's been since last 2 decades. So there is an integration happening in some shape or form. So you will see more and more funds moving or trying to integrate ESG in some shape or form. The degree of usage or integration will differ between what the strategy's main emphasis is and what they can adopt from the ESG, so that there is a good integration or not much divergence from the strategies that they were using. So going forward, you will see incrementally it getting more mainstream.
All right, so in today's episode, we had a broad overview of what ESG investing is, how it has evolved, and why these factors are important from the perspective of identifying sustainable businesses from an investment point of view. Next time, we would cover the nitty-gritties of ESG metrics, how one should evaluate them while investing, and look at them more closely in the Indian context. And with that, it's a wrap. Thank you, Chirag and Dhirendra, for answering those queries.
Thank you.
Thank you. Thank you.
Thank you to all our viewers. Do keep those questions coming and keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Take care. Bye for now.